Welcome to your third reference video, which is on India's option market microstructure. What do I mean by microstructure? Well, it is that structure which you can see from a microscopic view and understand the reasoning behind that structure being standing tall from some time. So here, what I'm going to do is reveal few facts with you, which will build certain conviction within you so that you can take this market from fundamentally correct stance. Well, one thing I want to mention here that if you are watching this third reference video of our course, Advanced Options Trading course in India, then it will be better if you complete your module 1 first and then come back and watch this third reference video. In first two reference videos, I told you about the insurance companies, I told you about options, I told you that how you can have a role of both, buying an option and selling an option both. And if you have covered module 1 properly and module 2 also, by this time you also understand that option is nothing but a kind of insurance instrument which people buy to hedge their positions. So it is one risk management tool. In my 990 rupees course, a complete course on Indian stock market, I have repeated it hundreds of times that you do not have to gamble your money in the market. However, there is a proper place for traders also in the market. But then trading has to be taken as a very, very serious job with a lot of commitment from time and effort. So here in this advanced option course, obviously that time and effort commitment will be required, and you should only continue this course or enroll to this course if you think that you want to be one successful trader, doing trading for years and years, or you want to make a career into option trading in some hedge funds or any market participants who offer roles of traders in market, or who offer roles for helping traders as an individual, as a employee. Well, coming back to the topic, yes, complete your module 1 and module 2 and then come and watch this reference video. But then let me also cover one very small concept of open interest and volume so that you can understand that why I have made this video, which I call as market microstructure of option market, and then why I focus so much that people should know that fact, that why this market is there, so much of popularity it has gained, and what should be your right role into that. But yes, freeze two things into your mind. One, option is a risk management tool and buyers are buying options so that they can hedge their portfolio is what my firm belief is. In which different ways they use options as a risk management tool is something which I have explained you in module 2 also. So go and even watch that also. But can you also sell option? Well, in the last class, I have explained you that also in the reference video that yes, you can play a role of option writer and option sellers. But you should be given the right knowledge and the fact before you decide whether you want to be an option buyer or an option seller. But if fundamentally I see, then fundamentally option buying is for the hedger. So only when I have enough underlying with me so that it needs certain protection, I should be buying option. This is close to the nature. This is close to the definition of the option. But then there are people who are buying option without having any underlying with them, which means that they are taking certain positions on which they are speculating that one fine day anything can happen and they can make a lot of money. But will they make money? Is it fundamentally correct or not correct is what you will see in this class. I think I have given enough background and made enough curiosity, and maybe you will be getting bored. So let me directly jump to the concept now and cover that. So first of all, let's understand what is open interest and volume. So you being one buyer of the option or seller of the option. whatever you are, you need the other party. So if you are a buyer of the option, there should be one guy who should be selling you the option, correct? So when one buyer buy one lot of option, hope you understand lot, hope you understand contract. So when you buy one lot of option, there should be one guy who should be selling this one lot of option. And when buyer and seller come together, you can say that one contract is open now. And that will be the open interest of that specific option. So for example, you have Reliance as a company in your portfolio worth 10 lakh rupees. You are worried that maybe in the next quarterly result, maybe after the next AGM meeting, something wrong can come and stock can fall. And you want to buy one put option. And then there is another party who think that by collecting the premium from the put option, he is more happy, more content, and he's one writer of option, one seller of option, and he comes in the market. You quote 20 rupees, he's ready to sell at 22 rupees, but both of you agree at 21 rupees and one transaction happened. And then you say that one lot got traded. For that one lot, there is one buyer and one seller in the market, and the open interest of that contract is one. So open interest, hope I was able to make you visualize and understand open interest. But definition wise, open interest tells the number of options and future contracts that are active or open in the market. So this guy is going with the option till the time AGM is there, and the other guy has sold it. He is believing that premium will decay and he'll get benefited. So both of them went home. It's not like in the 9:30 in the morning, this guy bought, another guy sold, and then in the evening, they both squared off their position. Someone who bought, he sold, and someone who sold, bought back, squared off their position. No, this is not happening. They both are going with the same position for the next day. And on that day, I can say that one contract was active, and that is the open interest of that Reliance put option. That's what I said. If put option, definition, and all these things you're finding it geeky, then yes, go and cover module 1. That's why I said that. Now, the volume is the number of contract that got traded. So what can happen now? Let's understand from an example. So let's say Sai came, he sold 100 lot of put option, the same one, and Aditya bought that. What is the open interest? Well, 100 contract sold, 100 contract bought. For every seller, there is a buyer. And here they are, Sai and Aditya. So 100 short, 100 lot. You can say that open interest is 100 and volume is also 100. On day 2, Sai, who have shorted it, still on the short position. But Aditya, who had 100 quantity long, or you can say he has bought 100 position, think that no, he should sell 51, half of it. He is not very confident. So he want to sell half of it, but then new guy comes. His name is Navjot. He said, okay, I want to buy that 50. At any price they transacted. Here what do you see? Well, the number of contract remains the same, which is 100. It's just that now Sai has shorted 100 and 50 is with Aditya and 50 is with Navjot. So what we can say that open interest is still 100. There is no change in the open interest. But there is one volume in the market which is 50. And total volume so far into this contract has become 150. So hope you understand what is the meaning of open interest and what is the meaning of volume. Now what do you see here? That on the second day volume is just 50 and open interest remains the same, which is 100. But think about thousands of people coming and trading in this market. They are coming and they are buying it from Navjot to Priyanka, Priyanka to Shashi, Shashi to Ram, Ram to Rahim. So many people are coming, and then they are exchanging their contract hands again and again throughout the day. Then what will happen? The volume will be not 50. Volume can become even 500. But open interest will remain same, which is 100. So what I can say? I can say that if lot of intraday trading is happening within option market, then volume can increase like anything. However, open interest will remain the same. It is very important for you to understand this, because what I'm going to show you next is going to reveal you something which will explain the market microstructure of the option market in current India. Okay, in current Indian time, I should say. So I'm repeating it. Open interest remains the same, but lot many people are coming and exchanging hands. Then you can say that a lot of intraday trading is happening here. Only one intraday trading happens, so volume is only 50. But I could have extended it. I could have made hundreds of more rows where I would have said that, okay, 10 o'clock, Navjot bought it from Aditya. 10:05, Navjot sold it to Ram. 10:10, Ram sold it to Rahim. And keep on exchanging hand of these contracts, and volume is increasing, and this volume can become even 1000. And if volume is 1000, what you can say that there is 9 times more volume than open interest in that specific option contract. So lot of intraday trading is happening. So lot of trading is happening in the intraday for options, which is made as an instrument for the risk management. But people who are coming and buying, selling frequently, they are certainly not buying it for the risk management. Because if someone will buy for the risk management, he would like to hedge his position for certain days. If he has to do it on the same day, he can simply place a stop loss on his holding. If I'm worried about what will happen at 2 p.m., because Reliance AGM is at 1:30, I can simply place a stop loss and I'll do my risk management. I'll not give premium in the form of options, put option. I am only doing intraday trading because I'm trading. Either I'm trading or I'm speculating, or the worst word is I might be gambling. Okay, now I want to show you a few things. And I found it important to make this video because I think that this can act as an eye-opener for a lot of people, and the most important people whom I want that this video should reach is the policymakers, to SEBI. They should really give a thought on this, that why this is happening. But anyway, till the time this is happening, it is one opportunity for you. And that's one of the reason I'm launching this course and teaching you trading, because I want to train certain people who believe in mathematics, who can backtest and understand that yes, if there is inefficiency in the market, if there's opportunities in the market, it can be grabbed instead of speculating or gambling. So the fact which I want to show you here is NSE become So here you have one news. NSE remains world's largest derivative exchange for second consecutive year. Means last year also they were the largest derivative exchange, and this year also they are the largest derivative exchange. Okay, what does it mean? It means in India we are having maximum number of future and option trade. In the stock market, only 3% of the population invest in India. In US, 50% of the population participate in the stock market. But volume of derivative market is maximum in India. So what is happening? What is the reason behind that? Let's see that where exactly this volume is happening. So 99% of the derivative trades happen on NSE. And NSE is the largest exchange. It means Indians are trading in options. I mean trading in future and options like anything. Now whether they are trading in future, they are trading in option, you can find that. Where you can find that? Look at this. Go to the market data. Look at the derivative market. See what are the top 20 contracts. Well, top 20 contracts are all options. Where? In Bank Nifty and Nifty. Of what expiry date? Weekly expiry. So do you really want to believe that people are buying options for the hedge management and the risk management purpose? So in every management book, in every management degree, people learning courses like CAs or any other graduate courses where they get introduced about the derivative market, the first thing they are taught is derivative is a risk management tool. But do you really think people who are actually participating in the market are participating because they want to use it as a hedging tools? And they are hedging their Bank Nifty positions with a weekly contract? All 20 contracts. I'm damn sure that these top 20 contracts cover 80% of the volume in market, or even more than that, 90% also. I don't have the exact data, but looking at the volume and everything, I can tell you that these are the weekly put and call option on Bank Nifty, which is the maximum number of trade happening in India. And this is the reason that from last 2 years, India has become one of the country where maximum derivative trades has happened. I'm sure all of you know about Mr. Warren Buffett. You know what is his statement? His statement is derivative is a tool of mass destruction of wealth. Something like this. Let's see what exactly is. Are financial weapons of the mass destruction, carrying dangers that, while now latent, are potentially lethal. Which means that people destruct their wealth through derivative market if they trade or gamble in them. This is what he mean to say. So when so much of people are participating in derivative market, you can understand that what exactly is happening at this point of time. So yes, people are not participating for the sake of risk management or for the hedging purpose for this option, and this is further you can see from the volume and open interest. Now you look at the open interest of this topmost contract is 1 lakh. However, the volume is 6 lakh, 7 lakh. By end of day, if you see, I'm recording this lecture in the live market. By end of day, when you will see, open interest will remain almost same. See, 12 o'clock it is. So open interest may remain same or even come down, but this will go to 20 lakh. In the top 5 contract, most of the time you will see that the volume is at least 15 to 20 times of the open interest. It means that, which further affirm the fact that market is full of intraday traders who are trading, speculating or gambling in the market. Now it is up to you what you want to become. You want to become one speculator, you want to become one hedger, you want to become one trader who believe in mathematics, probability and statistics, and learn a proper method, proper way, so that he can become one successful trader in the market. So in this course, we will be making you that trader. But then you have to cooperate with us. You have to understand these facts and assimilate that also. You have to believe in it, or at least cross-question it with your co-instructors, or email me if you don't agree with me and want a debate on this. But I firmly believe that right now people are coming and gambling and speculating in this market, and everybody is aware about it. Be it the policymakers, be it SEBI, or be it exchange, it has become one market where people are coming and satisfying the urge of gambling. Because they are trading, and most of the people, when they come in the option market, they come as a buyer. Why they come as a buyer? Look at this contract. The very first contract, which is the most active contract right now in market. It is Bank Nifty, weekly option. The price is 145 rupees. 145 into 25, 3,600. To participate in the derivative market, all you need is 3,625 rupees in this market. So for all the retail traders, it's very easy to bring that money. And even if they lose 1, 2, 3 trades, they keep on thinking that as a buyer, one day they will get lucky and maybe this will become 5 times or 10 times. But will they ever become? On a regular basis, if they are going to make 200 trades, are they going to make money? This can mathematically be proven. Everybody who understands probability, the basic of even probability, can see that in what instances, in how many cases, what percentage of success can come if someone keep on blindly buying options. So maximum people have very, very low entry barrier of 2,000, 3,000 rupees, which they bring in the beginning, participate in the option market, most of the time lose and go home. And in this course, we will not allow you to do that. We are there in this program to handhold you, explain you all these kind of microstructure of this market, and warn you that where you can lose money and where exactly you can make money consistently. How you can backtest a strategy and on what strategies you should get a mastery on it. So I hope I was able to explain you few things and was able to make it an eye opener that what exactly is happening and what people are doing. So one thing you understand here now. So most of the people are coming, and since entry barrier is very, very low, they are buying it. Now I want to explain you another concept which I call the game theory. Okay, that will further tell you that where exactly your position should be, what exactly you should be doing, and where exactly behavioral finance is hitting you, okay, or where it can work in your favor. So let's learn to play one game. So far what I have established with you is option buying is for the hedging, but people are participating in market with very high volume without even thinking about hedging it. Most of them are trading. Even if I believe in the open interest versus the volume, 20 times more people are just trading and not taking the contract forward, which means if I believe that all those people who are taking forward their contract, maybe they are hedgers, but let me tell you, even they are not hedgers. It's just that they are not doing intraday, but they are buying options with a view of 2-3 days till the expiry. But even if I believe that everybody who's carry forwarding options so that they can use options as a hedging instrument, still 95% of the people who are participating, they are participating either as a trader or a speculator and gambler. Which part you want to belong is up to you, for which you have to become wise on the option market, you have to become smart, and you should know these facts. So more and more such facts we will keep revealing in this program also. Okay, now let's learn to play one game where I'll explain you or try to relate. I don't know how successful I'll be in terms of relating it, but yes, it makes a lot of sense to a lot of people. Maybe it will make sense to you also. So let's learn to play a game, and this is a game of dice. I'm sure all of you have played Ludo in your childhood, and some of you might be playing even now. Well, a game of dice, what could be the probable outcome? 1, 2, 3, 4, 5, 6. These are the 6 outcomes which can come. Now, what is the rule of the game? The rule of the game is you can roll the dice as many times as you want. Your payoff will depend on what is the number which is coming on the dice, right? So payoff means for playing the game, you have to pay something. And if you get certain outcome, you will be paid back something. So maybe I give 1 rupee to play, and outcome could be 1.5 rupee, 2 rupee, 3 rupee, or there could be nothing. Something what happens in lottery basically. Sometimes your payoff with just 10 rupee lottery is even 1 crore. Sometime or many of the time you will not get anything. So here you have 6 outcome only, not like 1 lakh lottery points, but 6, only 6, easy to explain. Okay, what will be the payoff? Payoff will be 0 or number on dice minus 3, whichever is maximum. So number of dice could be 1, 2, 3, 4, 5, 6. If you get 2, then what will happen? Number is 2, dice minus 3 is minus 1, 2 minus 3 is minus 1, 0 or minus 1, which is higher, 0. So if you get 2, you get 0. You get 1, you get 0. You get 3 and still you get 0, because 3 minus 3 is 0, 0 or 0, you will get 0. But then if you get 4, if you get 5, you get 6, what exactly you get? Here is the sheet. So if you get 4, you will be paid 1 rupee. You get 5, you get 2. Why? 5 minus 3 is equal to 2, 0 or 2, maximum is 2, you get 2. Then 6, you get 3. Okay. So maybe now you have to be, either you can be the player or you can be one of the guy who is going to organize this game altogether. You think that there are people who think that, okay, fine, I am gonna play this game and maybe I have a probability that I can get 6 and my money will get tripled. If the price of the game is, let's say, just 1 rupee. Okay, so price of the game in the beginning, let's understand, is 1 rupee. What do you want to do? You want to be the buyer of this game, or you are one guy who is going to set up so that other people can come and play this game? Well, 1 rupee and 3 rupee you can get. So, but the probability is 1 by 6. But so for so many people who believe in gambling, who believe in luck, they will try their luck because their money will get tripled in one case, their money will get doubled in one case, and in one case they will get back whatever they have staked upon, but they will have the fun of playing the game. A lot of people I know who also come in the market because thoda time pass ho jata hai yaar. This is the statement they make. Okay, so 3 chances, he will have either fun or doubled the money or tripled the money. So they will come and buy. But there should be people who will offer this game. Now it's up to you where you want to belong. So if you want to belong from those guys who want to try the luck, you will come and only see that what is the price of the game. You will, and what are my chances. So even if you have very little chance, even the price of the game is 1.5, you might end up playing. You might end up buying. But then if you are one guy who is setting up the game, you will calculate everything. What will you calculate? You will calculate that I have 6 outcome, anything can come because the dice is fair. 6,000 times people can play and every time they will give me 1 rupee. But then all that 1 rupee can go. Why? Because in 6 time, if one person is playing, he may have chance to get everything 1, 2, 3, 4, 5, 6. So he will pay 6 rupee, and in return how much he will get? He will get 3 rupees, 2 rupees, 1 rupee, 6 rupee. So 6 rupees he is staked, 6 rupees is the chance he has. Dice is fair, he will get back that. If I generalize it to 6,000 times, this is what will happen, that one person who is offering the game, he will not make anything, and the person who is playing the game, he will also not lose anything if the dice is fair and they are playing it for the unlimited time. So the person who is offering this game will never participate in it. He will say that, see, I'm organizing this game, there is the shop I have set up, I have employed people, more like casino, I have an operational cost, so instead of 1 rupee, I will charge you 1.1 rupee. I will charge you 1.1 rupees. So in 6 game, I will gain 6.6 rupees and I will end up paying 6 rupees. So 10% margin is good. Some may say that I want to, charge for one game 1.2 rupee. So here, this is what you have to understand. When people are having so much high demand of buying the options, the prices might get higher. So there are 2 things in option pricing. One, people understand that what should be the right price of the option, which they should give. In this course, we're gonna teach you that also, how to price the option, what are the factors which are there, which establish the price of the option. But then what you can see here, that the very natural thing that most of the people are coming and playing this game, then probably you can think about becoming one guy who is not playing this game out of greed, but you are one guy who is becoming a facilitator. So you need to learn that pricing mechanism, and you have to understand that whether in longer run with the probability, whether it's a profitable business to do or not. So when you have joined my advanced option trading program, I am gonna make you one businessman who is coming and offering this game to millions of those people who are coming and trying their luck in the market. I'm very bluntly telling you this. This is happening, that so much of demand is there. People are even not looking at option. All they are looking is, okay, fine, I'm buying one in 3,000 rupees. Even if I lose, there's okay, but there's a chance that I can make 10,000 rupees, and for that reason they play. Doesn't matter what is the probability. In longer run, by participating, how much money they are losing. So people who have underlying and using it for the hedging purpose, then I can understand that they are not gambling or speculating. But here 98% of the people are speculating and gambling, and this is one opportunity for you where you can offer this game, become one option writer, backtest which strategy have worked really well with 80-85% of accuracy, where you would have money, and carry it forward for months and months and months. till the time microstructure remains the same. Now you may say that till what time this market microstructure will remain the same. Then on lighter note, I want to tell you something. Till the time government is not allowing corporates to open casinos in Delhi, Mumbai, Chennai, Bangalore, Hyderabad, Pune, Kolkata and other B-town C times, till the time gamblers in the society who have that inclination to gamble, or till the time we have enough financial literacy where people understand this fact that they should not heavily participate into something which is actually gambling. So there are two people who are gambling in the market. One, they have lower financial literacy about options. Or two, who actually have the tendency to gamble in the market. They were looking for something. And since organized casino is illegal in India, they got this. I know I'm making a very hard statement, but then I strongly feel that so many people participating in option market just for the speculation purpose is not right even for the country. Okay, but I'm not the policy maker and I'm not going to change it. All I can do is I can make people aware that what is happening, point number one, and to some people who actually have very keen interest in trading, I can teach them how they can make sure that they get benefited out of it. There's a role of trader in the market. He bring liquidity. He offer the solution to the hedgers. So there will be the option writers. There will be people who will be writing options in such a way that their overall position is hedged, risk-free. They're not losing. In the last reference class, I also told you that yes, many times option writer will make money, but when they lose like anything. But those situations can be protected. You can write options and you can yet predefine your maximum loss. And all you need to do is plan the game in such a way that probability works in your favor. This is something which you understand along with the market microstructure which I have shown you of Indian market. It will make you a wise as well as a smart trader. Well, on that note, I would like to conclude this class. But before that, I would like to summarize something. So options are for the hedging purpose. But in India, maximum people are not buying options to hedge their portfolio. By looking at the top 20 contract on NSE, we can see that there is a huge volume where people are trading in intraday in these options. Entry barrier for the people who come and participate in options is very low when they buy option, and most of them end up buying options because of two reasons. One, entry barrier is very, very low. Two, they believe in their luck. They have a tendency to gamble. But then to facilitate these gamblers, there are enough smart people who come and plan their trading strategy as an option writer, and they are hugely profitable. You have to become one of them. It will take time, it will take commitment from you, and you have to be one guy who take this as a business, who don't take trading as one thing where they will come and try their luck. No, you have to plan this business. You have to bring capital. Okay, and the capital could be as low as 60,000-70,000 rupees also to start with. This is what we will explain you in the further classes, where we will teach you about one strategy where you will be able to participate in one of these Bank Nifty and Nifty option, where you will be a writer, and still you will not require a huge margin, but you can manage it with 55,000-60,000 rupees also, but can make a consistent return. Okay, so I will be waiting for your comments on this specific video, where I really want to some of you or one of you who don't agree on whatever I said to challenge me back or enlighten me that whether I made any wrong statement or something, because this is completely my own original content. This is a completely my own understanding and my worry also about this market. In a mature market, there should be no such thing happening, but it is happening in India, and I think it will happen for some more time. In longer run, it is gonna harm the market only, because if people will lose money, they will have lesser belief in market, and if they will have lesser belief in market, they will not come in the market to participate with good companies where good founders are trying to do something, trying to come up with some really good product and services so that India can become independent and not import things but produce things within the country. And that's how probably one day we can become a 5 trillion or 10 trillion company, when we become independent. But to become independent, we have to form companies. To form companies, people have to give money to those promoters, those founders. They have to participate in the market. If they are participating it for the sake of gambling, I think it is gonna harm. I know I'm giving a lot of morality lecture here, but then this is the way I also justify why I have launched this course. One of the main reason behind launching this course, to let people know that this kind of thing is happening. They have two choice: either they understand it and don't do anything, or if they really have one inclination towards trading, they come and they do it right way. Well, on that note, I would like to close this lecture. But yes, as I said, please complete your module 1 and module 2 and then rewatch this video. Then probably it will make more sense to you, because a lot of concepts I have covered with example there in module 2, that how options are there and how people actually use options for their real business purposes. Well, on that note, thank you. See you in the other modules. Thank you.